Hey everybody, welcome to this free edition of our Trading Weekly Roundup for the trading week ending July the 19th, 2024. I'm President Brent. Thanks for tuning in. Well, the theme this week is, will the rotation continue? And rotation, I mean from growth and mega cap tech to value. Let's just take a look at how this week fared. Very interesting week. You can see here on the screen that the Dow and the Russell actually were in the green for the week. Russell up 7.67%. Most of those gains coming over the past week or so. NASDAQ and the S&P suffered a down week. NASDAQ especially down 3.62% for the week. I mean, the market was mixed. We had the value stocks outpace growth by about 4.77%. Looking at it from the Russell perspective, that's the largest divergence since March of 23. Okay. A lot of big factors in this underperformance of growth stocks was the huge decline that we saw in chip stocks on Wednesday. And that was, a lot of that came out with Biden administration talking about putting a lot more strict tariffs on chip stocks going to China. And that was coupled with Trump's comments on Taiwan. So it really caused a big drop in these giant chip companies, Taiwan Semiconductor, Broadcom, NVIDIA, all of these things, all the market cap fell huge just on that day, but it kind of set the tone for the remaining part of the week. You can see the PE ratio on the right-hand side of the screen, still very rich. The trailing 12-month is 24. Ford is just slightly under 23, so still very, very high, all right, in my mind. Earnings yield 4.45%, 10-year treasury a little bit higher. We did see this week's economic calendar, generally though, surprise to the upside. I mean, we saw retail sales jump 80 basis points in June. That was above the consensus, and it's the most jump in a month since January of 23, going back, over a year and a half. Building permits also rose 3.4% in June as well. And that ended 3 consecutive monthly declines in building permits. And we did see that industrial production also increased a little bit. So all in all, economic data this week was above average, or at least above expectations. We also got Boom Powell addressing the central bank's dual mandate during his speech this past Monday. He said that now inflation has come down and labor markets have indeed cooled off a little bit. We're going to be looking at both mandates. He also kind of gave a green light, what a lot of market participants think is a rate cut in September, by saying we don't need to wait for inflation to come down to 2% to start our rate cuts. So the market's got about a 95% chance of the first rate cut happening in September. In fact, the markets have gotten aggressive and said there could be possibly 3 rate cuts this year. That would mean September, November, and December. Remember, we got a Fed meeting into this month. July 31st is when we get Boom Powell at the press conference. There is no meeting in August, but keep in mind we have that Jackson Hole confab. That's when all the central bank muckety-mucks meet in Jackson Hole, Wyoming, and then generally we get some news from some central bankers. They talk, but it gives them a chance to all get together and chat a little bit about what's going on. You can see the best performer for the week was obviously real estate, up nicely, communication services down, technology year to date is still leading the way. Real estate is underwater, or just slightly in the green rather. So that's okay there. So even though we've had this strong pullback, everybody is still doing fairly well year to date. Okay. Then of course, if we come over and we take a look at the European markets, you're going to see over here in Europe, the ECB this past week, they kept their interest rates unchanged at 3.75%. That was expected. The ECB president, that's Christine Queen Bee Lagarde, said that a move in September was wide open. So they're not even committing to September, although we know Boom Powell, in all likelihood, will do a rate cut of 25 basis points in September. At least that's what the markets are forecasting. So Queen Bee Lagarde, they tend to trail the Feds. So we could see something over there in Europe as well. Meanwhile, over in Europe, industrial production fell in May 60 basis points. Okay. And that's the first decline since January. But we're also seeing output dropping just slightly under 3% in Germany. And we're seeing drops also in Italy and France. So Europe is the underlying current there is a lot weaker. So it may force them to cut the rates since they did this month than probably in September. Okay. You can see everybody was in the red in Europe this past week. And the CAC 40 moved back into the red year to date, 11 basis points underwater. Okay. Then, of course, if we look at the Asian markets, just take a look there and basically see what's going on. That's not the Asian markets. If we look at the Asian markets, you can see that in Japan, there's still a lot of speculation about whether the Bank of Japan is going to hike interest rates at their meeting the end of July, right at the same time the Feds are meeting. Okay. We'll see how that works itself out. Meanwhile, I've been telling all our members, and you guys too in our free weekend session, that you want to be long the Japanese yen. Okay. I think long term that's a low hanging fruit trade, meaning I think it's going to move up. We've had 2 weeks in a row now of the currency, the yen, moving up a little bit. We also saw Japan CPI rose 2.6% year over year this past month, and it was up from 2.5% year over year move in May. So it is moving up. Overall inflation in Japan is holding steady at 2.8%. So all of that stuff is good. But they did lower their GDP growth forecast for the current fiscal year, which ends March of 2025 to 90 basis points expansion. That would be from a gain of 1.3% they were projecting earlier this year. Okay. But that's where the Nikkei down a little bit on the week, but still very strong and robust. In fact, leading all the major countries that we follow right now, up 19.81% for the year. Meanwhile, in China, you can see China barely eked out a gain for the week, and it moved them just barely into the green year to date. Their retail sales grew at a below forecast rate of 2% in June, and that was down from 3.7% in May. We did see some industrial production rise a little bit better than expected, but still, the real estate market in Japan continues to act as a drag on their overall economy. New home prices we saw there fall 70 basis points in June, and it also fell 70 basis points in May. So it's the 12th consecutive month of losses are going down for the real estate market. So that does suggest that a lot of the historic property rescue package and stimulus that Chinese government has put into the economy has just really done very little to turn the property market slump around. So I think it's going to take a little bit more time for that to really take hold. What I want to do is just shift you over and just take a look at some of the major indexes here and just give you my take on them. If we start off with the E-mini S&P 500 futures, it'll take a couple of seconds to come up on your screen. You're going to see that we're off of the highs here, but not by much, just barely under 3%. So that's not even a really bad day on a strong bear market. We're down 2.95% off these highs that were made on July 12th, right? We were up at that time 18.61%. So we're down about 3% off of that number right there. You can see I've got some support points here. One of them right around that gap move right there, sitting around 54.54, right? I could see us coming down. The 50 EMA is just slightly above that. And then I got a little bit further out in time, third week in August, around 53.42. So call it 53.50 area, somewhere in the middle of that range. So I do see markets, as I've been telling you guys, pulling back in the July-August timeframe. Not too much, anywhere from 3 to 6%, I think is what I said. We're just slightly under 3% now. And then we'll probably get another run, and then we'll have a bigger drop sometime later this year. All right. Now, a lot of this is dependent on earnings. As you know, we got some mega cap, stocks starting to come out with earnings next week. In the next 2 weeks, we're going to get a really good idea. They controlled 30 some odd, 30, 32, 33% of the total weighting index and probably 60% of the total profits in the S&P. So, if they turn south, it will continue this down drop that we're seeing right now. Okay. If you look at, and of course, if you look at the NASDAQ had an ugly week. And you can see this channel that we're running up on here. We hit the top of the channel over here on July the 12th. We were up 23.41%. Now we're coming down to the bottom of the channel. Will it hold? It all depends on where earnings are starting to go, but we've kind of closed this gap down here. Should this break, it's going to make a run. All right, but it's going to take some ugliness out of the mega cap tech earnings to make that happen. You can see there's a little bit of a bearish divergence on that higher peak there. That does suggest a little bit more of a downdraft than we would expect from, say, the S&P. In fact, if I were just kind of to do a back of the napkin look at this just to get an idea, we're down around 6% in NASDAQ. These are NASDAQ 100 futures, okay? So a little over 6% in that one. And just slightly under 3% in the S&P. Okay. And then, of course, if we look at the Dow was one of the rare indexes that was in the green this week. You could see that was Friday, but we really moved up very strong. We had an all-time high in the Dow on July the 18th. It was up 9.75%. Then we just pulled back. We gapped down big time. And I think if we do have that little bit more of a pullback, you'll see the Dow come in and start to backfill some of these gaps a little bit lower. And then, of course, if we look at the Russell, what's really interesting in the Russell, look at this thing. Literally, we were in the red in the Russell intraday on July the 9th. And then we made the entire year in less than a week for the Russell. So if you weren't in the Russell all year, but just got in it this week, you made your year just in the 5 or 6 trading days here with the rut. It was up 12.71% intraday, and now it's backing off a little bit. Is this rotation going to continue? I'm not entirely convinced that it will. Okay. We're going to get deeper into earnings season this coming week and the next week, and that is really going to give us an idea. In fact, this week I think we have 138 S&P companies coming out, including 7 Dow companies of the Dow 30. We'll get 7 of those. So we're going to get a lot of earnings. We're going to get a good idea, and we're also going to get the PCE producer or personal consumption expenditures this Friday. That's a preferred gauge of the Feds. Is going to give us an idea where the Feds want to go. And then we get the Feds next Wednesday with Boom Boom Powell. So a lot of data coming out here shortly. Okay. A lot of good stuff. Now, if we come down here and we look at the VIX, you can see here in the VIX that we moved up as expected. We were down. We haven't been down this low in years. And then, just pre-COVID down in this levels down here, an 11 handle, right? In fact, here intraday, we were down right around 1160. And then we bounced up. Every time we get down here, the odds favor move higher. And then you could see the move up like this. Some of our members, we have a way that it's about the success ratio is about 92%. On a trade that we love to do in the volatility markets. And I know we got some members making that trade right now, and it's not the way you would think. But we play volatility to do its thing. And it's usually a very successful trade for us. Anyway, here you can see the VIX up in the 16. Now, if we get that pullback that I'm looking at, I said anywhere from 3 to 6%. So let's say we pull back another 2 or 3%. We'll see the VIX come up into the high teens. I don't really see a reason for it to get into the 20s on this initial pullback. I think we're going to pull back a little bit, consolidate, make another run at the highs. We may beat those highs. We may come in at or slightly below those highs, and then we're going to have a further pullback in the October-November timeframe, leading up to the Christmas season Q4 here in the U.S. And then, of course, if we come down here and look at treasuries, or we look at the bond market, you can see the interest rates are moving up in the bond market. The bonds are moving up, higher lows, higher highs. We're hitting a little peak here. This is almost like a ascending triangle here. with this. And typically when you break this, the odds figure a break up, which would mean interest rates lower. But there's the longer end of the curve is staying interest rate wise a little bit higher than normal. And we'll see how that plays itself out. It's affecting the yield curve. And members, we'll go in a lot more detail on that in this Sunday session for our members. And then, of course, if you come down here and look at currencies, the dollar is below the 50 EMA, below the 200 EMA. I think the dollar will come up here, but it's to sell the rally in the dollar. And in the euro, it's to buy the dip. You can see here on the euro, it's probably going to dip down. You can see the 50 is just now crossing over the 200, which is kind of running flat. There's not a trade right now here. We're making higher highs, higher lows. I think this is going to settle in a little bit and then make another run. Right now, I wouldn't touch the euro. Okay. And then, of course, if we come down here and we look at gold, I think gold's going to settle down more. It had a nice, quick, fast run. You can see this run right here, right up to my target, which was sitting right at the target level. It came in a little bit late. My target was for gold to hit here in early middle of June, but we're in the coming into the middle of July to the last week or so of July. So it hit a little bit late. I think we're going to pull back to the 50 EMA. I think it's going to break. I do believe we're still going to fill this gap here with gold, and then to me, gold going long it makes a lot more sense. And then finally, if we come down and look at energy, oil is a really great trade for the way we do it. You could see this pullback here comes into our sweet spot. It may hold, it may not. I think if the economy, the global economy continues to slow down like it is in Europe, and it is slowing down here a little bit here, and they don't execute a soft landing, you're going to see oil come back down below here and test these lows out here in Q4 of this year. For now, it looks like a buy the dip on oil, where it may come down a little bit more and make another run up, and that'll be it for the year for oil. Okay, but there's an easier way to trade this. Members, I've shared that with you, and we're successful in how we run that trade. Nat gas, it's in a no trade environment right now. You can see here our shorts up here. This was the time to short nat gas. Over here I was talking about going long nat gas, and now it's just coming back down here. In this area here, it's in what we call no man's land. It can go up, it can go down depending on the weather, depending on the inventory levels. It's a lower probability trade to take. So we're just going to stand down in nat gas and wait for another setup at another time. All right, everybody, that's kind of where we're sitting. Enjoy your weekend. Members, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao now.